Okay, so I would like to welcome everybody here today to the International Macro History Online Seminar Series. I'm happy to uh, introduce today's speaker, Cameron LaPoint, who's at the School of Management at Yale University, who's going to be giving a talk about housing in the financial cycle, historical evidence from the 100 years of local building permits. So it's really nice to sort of see some names that I recognize in the participant list. So the rules of the game are as the same as previous seminars. Please, if you want to ask a question, use the Q&A, not the chat room. So you ask a question. I will at the end of the presentation in 40 minutes. I will then sort of open up for the questions, and I'll look for the themes and questions and ask the questions as asked in the Q&A, and then we'll get some back and forth, and the seminar will finish formally at in 1 hour at 6 o'clock European time. Just want to note that next 2 weeks times seminar has been loaded up in the chat for those who are interested to see what's going to happen in 2 weeks time. So anyway, it is my pleasure to introduce Cameron. Welcome, and I look forward to a really interesting and seminar. So very good.
Wonderful.
Oh,
Thanks for that. Oh, sorry, go ahead.
one last, can everybody make sure they've turn off their audio? That'd be great. Thanks. Bye.
All right, thanks for that the introduction, John, and thanks to everyone for joining me today. Talking about a paper that's a fairly mature paper now, but we're hoping is going to be a research agenda using this new data source that we hope will be a public good for the profession at the conclusion of this first paper. I'm joined work with Gustavo Cortes, who is the resident economic historian among the two co-authors. And so Gustavo has kind of brought me into the economic history community through the work we've had together on this. So the title is really an homage to an idea that Ed Leamer popularized in naming the title of his Jackson Hole Economic Symposium speech in 2007, Housing is the Business Cycle. And he opened this with a very, some might say, dramatic quote in which he said, "My goal is to provide unforgettable images that leave a lasting impression regarding the importance of housing to what we call the business cycle." And so today we're going to really be paying homage to Ed's work, extending it over a longer time series, but also we're going to be extending into the geographic cross-section as well to try and highlight mechanisms behind why Ed felt so strongly that this was that housing was a leading indicator for where the economy was going. So that said, you could think of this paper as studying an old question with new data. So Ed was not the first to ask the question of why does housing seem to matter? And so I think it would be useful before I dive into what we do to just summarize what economic historians before us have observed in terms of correlations between housing market variables and macrofinance. So I think you could go back even further than this, but I think two prominent examples of this phenomenon in the US. So Clarence Long, who is an economic historian at Wesleyan University and a congressman from Maryland, wrote in his QJE paper in 1939 that the building industry is probably the most strategic single factor in making or breaking booms and depressions. Of course, at the time, Long was thinking about the US experience prior and then right after the Great Depression, which is another prominent housing crisis. Cullen and Newcomb, in a book that was sponsored by several government statistical agencies, are echoing this idea, and we're trying to really create these construction sector indices going back into the Civil War period and try to harmonize them and get at some kind of consistent trends, really echoing this idea and trying to highlight the construction sector is really quite volatile. Now, in the more modern era, just beyond Lemur, we have a lot of just sort of stylized facts about time series correlation between housing and the real and financial cycles. So Lemur popularized the idea that residential investment, as proxied by either the value of building starts or the value of new building permits, will consistently forecast GDP. That's the aggregate level. It will lead 10 out of 12 post-war recessions. If you look at Lemur's work, including the Great Recession, which is why Lemur was titling his speech "Housing is the Business Cycle" in 2007. And my co-author Gustavo has some work in the RFS showing previously that real estate volatility, as measured by some of the building permits data we're going to use today, explains the largest stock volatility spike in U.S. history, which is on the eve of the Great Crash in 1929. And it turns out that if you try to throw a lot of different financial market indicators into a regression and try to explain that large spike in stock return volatility, it becomes very difficult to do so without using some sort of construction sector indicator. I think just kind of this isn't in any a point that's made directly in any published work, but you could also think about just house prices versus stock prices. So house prices tend to precede stock market crashes in terms of index levels as well. We're going to really be focusing on quantities in our paper. We do a lot of tests to show that using quantities, uh, permits or building starts will be a little bit more forward-looking than prices in any case, as far as housing market transactions are concerned. So, taking stock of all this evidence, there's a lot of time series correlations at play here, but where we're going to come in is we lack granular and historical evidence on the mechanisms. And in particular, when we're thinking about housing market indicators, it's not clear how each of these individual localized markets, to the extent that housing is a location-specific asset, are going to translate to the macroeconomy. And so we're going to do this big data exercise in which we both extend back some of the series that Lemur was using, but also disaggregate into the geographic cross-section. So what we do in this paper is construct a monthly building permits panel for all U.S. states and 60 MSAs going back to 1919. I'll talk more about the data, of course, as we go along, but just why do we have 60 MSAs and why do we truncate the time sample to start at 1919? These are 60 of the largest MSAs in the US, and these are the ones that we think we can define in a geographically consistent fashion over that 100-year time span. Um, in the 1919 aspect is that a lot of cities in the US didn't have robust permitting systems until the early 1900s, and this is reflected in some of the historical sources that we're going to be collecting these data from. So if you go back prior to 1919, you can construct some series as Colleen and Newcomb and Long tried to do, but it's really going to be for a much smaller sample of cities. So you won't have this representative geographic cross-section if you go further back. We're going to do this using some modern OCR techniques. I'll talk a little bit about some of the challenges we face there in case it's useful for some of the other digitization efforts that the audience might have. And we think that this is the first granular nationwide housing database that spans the pre-1970s period. There's been some contemporaneous work by Alison Schertzer and Ronan Lyons and co-authors trying to fill in housing price indices. So you could think of this as the complement to their work by filling in a quantity-based measure of the housing market. Our key finding is going to be that building permits consistently predict financial stress. This was going to be true in both the stock and the corporate bond asset markets. It's going to be true in terms of both returns and levels as well as return volatility. And this is going to work across over a dozen crisis episodes over that 100-year time span. Now, you might be saying, well, is it just that building permits are picking up other types of fundamentals in the economy, whether those are local or aggregate indicators? And this predictive relationship is going to hold conditional on proxies for housing demand. So you might think that all of these papers like Mankiw talking about the baby boom in the late 1980s and early 90s in the US, that population growth is just going to mechanically push up demand for housing. And so, of course, developers are going to issue more permits. Even if you net out these types of fundamental drivers of housing demand in the economy, we're still going to have some predictive power. Other things that might be driving housing demand, of course, access to credit or how cheap credit is. So interest rates are going to be potentially important, as well as physical natural disaster risk. So if you have a hurricane that goes through Florida in the 1920s, then building permits are going to fall off a cliff in part because no one's going to want to build new housing in the aftermath of the storm, although there might be building permits for repairs of existing housing. Now, what do we do with all this information? So, we're going to propose what we think is a novel mechanism for why building permits are a forward-looking signal. Basically, this is going to be a extended version of the textbook Grossman-Stiglitz model that a lot of people probably get exposed to in first or second year macro graduate course. The idea here is that in that model, you have informed and uninformed investors. The informed investors are going to observe some sort of signal, and then the uninformed investors are going to infer price movements in the risky asset market based on what the informed traders are doing. So they don't observe the signal directly, but just through kind of price revelation, they can kind of figure out whether returns are going to go up or down, or whether volatility is going to go up or down. Um, and so what we're going to do is take that notion. We're going to say, okay, well, now we don't just have um, we have one unitary asset market, but we have these signals that are disaggregated by different, island economies, or it could be sort of islands that are somewhat networked. And that signal is going to be growth in the construction sector as proxied by building permits. So we're going to microfound that signal in the Grossman-Stiglitz context by saying that real estate developers have some local information. They have some beliefs about where their particular local economies, where they operate, or where those economies are going. And permits are going to reveal what they think is going on because they are a call option, right? So they're an option to build. And so if you file a permit, it suggests that as a developer, you think that the fundamentals are good, at least in that area, and so you want to build. And so we think that this is the mechanism through which permits are revealing information flows from Main Street to Wall Street. So let me just preview before I go into the results. Like here's the 100 years of data in, I think, one very nicely summarized figure. So the black line here is going to be the building permit series for the entire United States. The way to read this is log a building permit at quoted cost. So this is basically if you had a contractor today and you got a quote for building a new home, that would be reflected on the permit that gets filed, and then we sum up all of those building permit values, and we seasonally adjust those levels, and then we deflate them to real dollars. So that's the U.S. in the black line, and then you might say, well, why do we have Florida and Connecticut on there? Is it just because I'm at a school in Connecticut and my co-author is in Florida? Yes, but also one of the things that becomes clear when you dig into looking at whether there are some states or cities that are much more predictive of the macro cycle than others, is that states where housing supply is relatively elastic, where it's pretty easy for developers to build, are going to have a much higher signal to noise ratio. So that is, they're going to be much more revealing about where we're going in the economy. And so that would be states like Florida, which have historically had a lot of land that's ripe for development, but also where in the more modern post-1960s period, regulatory land use constraints have been more lax. In contrast, in a Connecticut, you'll notice that these blips up and down are much less reactive. Um, on the eve of these recession periods. And I think that's reflective of a large literature arguing that Connecticut is not only a more land constrained state, but has very stringent land use requirements, particularly minimum lot size regulations. So I'll delve into all these different measures we have for dividing up the states and geographic areas by their constrainedness with respect to housing supply. But the idea here is that permits are going to be much more free to move, and so are going to be more reflective of investors' beliefs about where those local economies are going in areas where you don't have these supply constraints. So let me just put some numbers to these results. So we think that building permit growth, but building permit growth volatility in particular is going to offer a new factor for forecasting crashes in stock and bond markets. as I said, this heterogeneity is going to be based on supply elasticities, how easy it is to build. If you want to think about just sort of a running example, Florida is going to be a very high signal to noise ratio state with regards to permits. And we're going to do a kind of zooming into the modern era where we know a lot about the narrative around the great financial crisis. We're going to show that this factor building permit growth volatility is going to capture some early info about which areas of the country will turn subprime. So the idea here is that if this is really about information, revelation, and you looked at, as of 2005, which mortgages were already classified by servicers as subprime, so something that is more or less private information to the servicers, not generally known, um, we can actually predict which areas are going to turn subprime using this construction measure. So in other words, there's some local information about like which houses are these McMansions that people can't actually afford. That is going to be known by the developers and then will disperse throughout the economy. We're also are in follow-up work. As I mentioned, this is sort of an agenda that we are hoping to produce a few papers on using this data. But we have some results in this paper on the firm cross-section. So there, the analysis extends um, by looking at just firms based on their plant network exposure. So these are primarily manufacturing firms that we have access to their locations where they produce goods. If you look at individual stock returns or return volatility, what you'll find is that the firms that are more exposed to these very volatile construction sectors based on their plant locations also will experience more volatility or lower returns in points in time where there is overbuilding or permits are excessively high relative to their long-term trend. I think in this literature, there's a lot of discussion, and I think some people in the audience today have done work on leverage cycles, or in particular, like build-ups and leverage on the eve of these financial crisis episodes. Um, and so I think it's important to emphasize that while leverage is definitely important and can be an amplification of the construction sector volatility that we're highlighting in this paper, we're still going to find that BPG is quantitatively important, even relative to different measures of leverage that you can bring to bear on this problem. So we do some horse race exercises, and we find that in the more elastic states like Florida, you can be standard corporate leverage ratios in an incremental R squared sense in terms of predicting stock return volatility. So before I get into the data, which I'm sure a lot of people are interested in, um, here's kind of my sales pitch. Why in the corpus of potential forecasting variables, why might we want to use permits? One is that they're continuously available at monthly frequency and they're disaggregated with nationwide coverage, at least in the US, over long time periods. I'm happy to hear comments from people if you have ideas on how to extend this internationally. We have some series going into other Western or into Western European countries. And so we would love to kind of build out this database globally as well, keeping in mind issues relative to harmonization. But if you think about like just sort of the off-the-shelf other economic statistics that we often use to think about whether we're going to be in a recession soon. Labor market statistics are always something that comes up. These are often released with long lags and they're often revised within releases or between releases. So you have to deal with forecast revision errors. If you think about just sort of the geographic component to this, in the US, we have the quarterly census of employment and wages. This is going to have a 5-month lag after the quarter ends. And state level BA employment is only quarterly and starts in 2018. So really labor market statistics are going to be much slower moving. They're going to be subject to these long lag times and revisions. You could also think about other types of real estate market indicators. So house price indices, important for getting a sense of affordability. But they're by and large going to reflect a moving average of past transactions. So they're going to be much more smooth relative to these blips in the construction sector. And so they may not have the informational content that quantities are going to highlight. We're also in this paper going to focus on single family homes. Um, I'm happy to talk more about why that is. We have data on multifamily home permits as well over this 100-year time span, but most of our tests are going to focus on single family homes. So these are permits that are filed to build a new one unit residence. Now, why is that? So if you start going into these large multifamily projects, then you're going to have issues with long lag times between when that permit gets filed and completion. We use some data from the 1990s onward just to sort of validate this, and we showed that single family home permits complete very quickly. And so we can kind of bound what the lag order is for predicting across these two segments of the housing market. Okay. I think a lot of people in this audience in particular have worked at the intersection of macrofinance and housing. I think really where we're contributing is new evidence in favor of Lemur's longstanding hypothesis that housing is not just the macro cycle, but the macro financial cycle, and providing a microfounded mechanism as to why. And then, as I mentioned, we're very open to, at the conclusion of this paper, we want to put together a website that has um, in an easily accessible way so you can filter out like particular states or geographies that you're interested in from our local building permits data so that you don't have to go and track down all the PDFs that we did to use this in your own research. So let me talk about the database construction. So these are all the sources that we used. The ones in Boulder where most of the sweat equity was put in. So the first main building block we're going to use is Dun& Bradstreet's review. So this is a monthly manual that was marketed to investors. It starts in the late 1800s. Again, we're going to truncate our sample at 1919 because that's when most major cities in the US started actively recording permits, even if they had permitting systems that went further back. These are going to be city level permit series, and then we will aggregate those up to the state level as well as to what we define as modern MSA boundaries. I should note that Gustavo, my co-author, and Mark Wienemeider in their paper in 2019 had about 10 years of this data, and so we are going to extend their series out to 1957. To validate the integrity of the data from Dun& Bradstreet's, we're going to use the fact that the BLS started producing their own annual construction reports over some of that time period, just to get a sense of do the annual totals seem to line up very well, and we find that they do. So that's kind of nice when you're working with historical data if you have sort of a private and a public publicly provided data source that the two line up. And then you notice that there was this gap in the 100-year series that I showed you. So at some point in the late 1950s, Dun& Bradstreet discontinued their permit series. Luckily for us, though, the Census Bureau started kind of taking a cue from the BLS, started producing a monthly building permits survey. We now have access, thanks to some staff at the census who were very kind to send us the original prototype reports from 1958 to 1960. We have a way of filling in that gap. It's just a little bit more effort on our part. But for 1960 to 1987, we just tracked down all the PDFs from regional libraries and Hathi Trust. And so these are going to be monthly snapshots, including single family and multifamily permits that are issued, their values, as well as the number of permits by MSA and state. Now, if you wanted to do anything or put into motion anything that we're doing in this paper in the modern era, or let's say you wanted to use our measure to try and nowcast more or less in real time, you wouldn't have to do that much work. You could actually just go to Fred, and with one or two lines of code, you could download all the modern census building permits survey. And we're just going to stop our sample at 2019 in part because I'll tell you up front, one of the two major recessions we don't predict in our data is going to be COVID, in part because it's sort of this global shock. It's a pandemic. Now people are staying inside. They can't build, so you get this kind of mechanical mismatch between the stock market and the housing sector as a result of the public health crisis. So we could definitely extend beyond 2019, and anyone who's watching this could do that as well. But I will talk a little bit about what permits tell us about where the housing market is going today, given that in the US we're facing a big housing market correction. Here's an example of the data from DUNS. So this is an annual summary of permits, and this is just a page that highlights New England cities. So these are the annual totals for 1939, 1938, 1937. And where we started with this project about 2.5, 3 years ago, we took Melissa Dell and co-authors Python package layout parser. which is basically a optimized deep learning Python package that uses k-means clustering, and it essentially identifies all of these red rectangular blocks and then spits them into an Excel, and then we do some post-processing to clear out common errors. Um, We've since started using Amazon TextTract, which I think works particularly well for tabular data. And so we have an automized routine now that will essentially split up all these massive PDFs into their component tables, load them into Amazon TextTract, and then at a very small monetary cost, will produce really high quality Excel output. One nice thing about this context is that we can check for internal consistency. So using something like layout parser or our own sort of scoring algorithm from the TextTract based solution, we can assign a score to each of these blocks, which is like a confidence interval. And then we can use that score to basically find pages that are degraded and then get fresh scans of them. So that was sort of the first step. The other thing is just that we've got for these Duns reviews, but also for the modern census, we have.
Cameron, there's a quick question which might be useful to answer. You said there were two recessions you didn't predict. COVID, what was the other one?
Yeah, so the other one we don't predict is the end of the Korean War. So there was a big
Okay,
sort of stimulus ramping up wartime production in the 1950s, and then so there's a recession that follows
okay.
from
And this
ramping
is a
down.
good time to tell you that you have about 10 minutes left.
Okay, great.
Okay.
So let me go fairly quickly then. Um, So we can check the row totals and the column totals here for internal consistency, and that allows us to see if there's anything funky going on with these scans. Here's the full 50 years, sorry, 50 states in one panel. So again, this is kind of generalizing the Florida versus Connecticut dichotomy that I showed at the beginning. But if you were to just pick your favorite states that have not been building enough housing in the US, so that would be primarily the New England states, that intuition would generalize. So these would be states where you just don't get nearly as much construction sector movement, and so there's less informational content there than in states in the South, where it's generally much easier to build, and there's a readily available land for development. So I'll skip this slide. I kind of have summarized this already, but we get some new stylized facts about historical housing markets from just plotting these time series. I think the most salient one is that single-family home permitting peaked in the 1970s and has largely collapsed after the financial crisis. Um, and and it's kind of consistent with a drop in new housing supply that a lot of that people have talked about as the root of the current affordability crisis. We show using data in the modern era that while we are looking at permits and not necessarily completed units, most single-family home permits, even in very high regulatory states like California, will complete about 80%. In so at least 80% will complete. In most states, it's close to 100% completion within 2 years, and rates of 90% completion within 12 months. So actually, for single-family homes, you have very high completion rates. It's multifamily properties that tend to have low completion rates. I'll skip this in the interest of time. We have a lot of supplementary data sources that are quite standard. The only one that is not standard is perhaps this building permits and microdata that we source from CoreLogic. Okay, so again, we're going to be mainly focusing on quantities, but um, and we think that the quantities are important because again, it's like you're exercising potentially a call option to build as a developer, and so that's where we think most of the informational content is coming from. You could also do this price times quantity decomposition. So there's a question of whether inflating up those quantities to some sort of market value of the house, if it were completed, matters, and you can think about like price versus quantity in the housing market, which one is better in a horse race sense. Quantities are going to be driving most of the variation, in part because prices are just smooth, then they're going to be backward looking based on past transactions. We're going to focus mainly on volatility in our tests, so we'll run these GARCH models after seasonally adjusting all the series. So we're going to account for the fact that Chicago has really bad weather in the winter, and so you don't build then. Florida does not. So we'll strip out that sorts of variation month to month. And then we're going to look at volatility because that corresponds in the macro finance context to the precision vision of building permits as a signal. We're going to use gauge models mainly because we're trying to forecast something that is very high frequency, which is stock return movements. Um, so we take the monthly standard deviation based on daily observations, whereas with building permits, we just have monthly frequency. So we have to do this in an apples to apples fashion. Here's the same plot I showed you, or a version of the same plot I showed you in terms of um, the lead lag order of volatilities in the construction sector. So that would be the black series in each of these graphs versus crisp total return volatility. So this would be like the stock return volatility on the index. So there are three recessions. I misspoke. That there are three recessions that we don't predict. Um, One is the Korean War ramp down. The second is COVID, and then the third one is at towards the end of the 1930s when a lot of the New Deal stimulus policies were suddenly revoked. There was a short recession that was induced there. That's the third one that we do not predict. I mean, I think that the Korean War and the COVID ones are sort of global affairs events, and so one interpretation of this is that this indicator may not work particularly well at forecasting sort of um, uh, geopolitically induced downturns, but it does very well at predicting what the domestic economy is doing. Um, we can do this in a regression framework just to be a little bit more systematic. We can strip out any sort of seasonality in the asset markets, account for any aggregate as well as local fundamentals, such as these other proxies for housing demand, like leverage ratios, population growth that I mentioned, ability to access credit, interest rates, mortgage applications. It doesn't seem to matter all that much in an R squared sense or in terms of killing some of these predictive betas that we're going to highlight. This is just the firm level version of this. So here we've got everything indexed by an individual equity J. Um, and now what we're going to do is basically think of this as like a Bartik share version of the main specification. We have all the plant locations K for all the firms J. We're going to weight up all of their individual construction volatility exposure across locations K using something like a sales or employment-based share. We're going to do this using Dun& Bradstreet data from the modern era. The sales data as many have pointed out in the corporate finance literature, is a little wonky. So our main version of this is going to use employment-based shares, which have been shown to predict out of sample census employment very well. Okay, here's a return on return regression. So this is just sort of, if you were to write down this Grossman-Stiglitz type of model, one of the things it would tell you is that each of these signals, so each of these like state level building permit series should predict returns. And you could do a detrended version of this as well. But if you just do returns on CRISP versus building permit growth here for single family homes with a 1 month lag, you would get a very strong predictive relationship there. Um, and this will holds conditional on a lot of financial and macro factors. So it holds conditional on commodity futures return fluctuations. This is not just about, oil prices spiking and that making it difficult to transport lumber to the US. Population growth, Shiller's cyclically adjusted price earnings ratio. You could also factor in movements in the yield curve, either through Cape yields or putting in different treasury rates. Industrial production growth is another common economic indicator, is not going to kill this, and household as well as corporate leverage ratios. I think importantly, if you think about like the information story that we're pushing with this building permits based measure, one thing that people often do to forecast stock return volatility is to look at the VIX as a measure of uncertainty. So if you could stick in the NVIX or the VIX, we're still not able to fully kill off that relationship between building permit growth and the stock market. Here's a volatility and volatility version, and now we have the corporate bond sector in here as well. Again, you could focus on sort of the magnitude of these betas here in the first row of this table, or you could focus on the incremental R squared. We do both in the paper, but one interpretation of this is in terms of magnitudes is that if you looked at the typical spike in the nationwide construction sector volatility, which is around 1 percentage point on the eve of a recession, this is associated with a 30% spike in stock return volatility relative to its monthly average in the next month. And importantly, this is true outside of the GFC or the Great Depression, which are both um, often discussed as major times in which there was a major buildup in household access to credit or a lot of subprime mortgage debt that's circulating in the economy. Interestingly, I think this is sort of the main result of the paper. If you geographically disaggregate this, so you could do this either as a penal regression or you could do it state by state. Here, what we're doing is plotting the state by state version of this. So we run a separate regression nationwide, Florida, Michigan, etc. And then we just rank all the states based on their predictive loadings. And we do this for different horizons. The 12-month horizon we select mainly to account for the potential lag between permits and completed units. Although everything that so BIC optimal here is going to be 1 month in any case, but so the betas sort of accumulate over time in most cases. To the extent that there is some attenuation as you go from 1 month to 6 months to 12 months, that generally reflects this lead lag order that might be specific to particular states. But this is to show that like the signal to noise ratio um, uh, a phenomenon seems to be related to how easy it is to build housing in these states. So if you look at pre-1960s, a lot of these states that are going to be at the high end of this bar plot are going to have a lot of undeveloped land. They're going to be states where people are able to move, and developers are going to face far fewer frictions in building. If you look at the modern era, it's going to be driven mainly by land use regulation. We have a long discussion of this in the paper. What are the right measures of land use regulation to use?
Cameron, I
Um,
just you have about 3 minutes left, so uh, maybe
okay.
3 or 4 minutes to finish up.
Sounds good. Okay.
Okay,
So basically this is like, the geographic heterogeneity that we have and predictability. In the pre-1960s data, the rankings flip a little bit. We have some discussion in the paper about, a lot. This has to do with the 1960s. There's a big regime shift where a lot of these municipalities and states start passing more stringent land use regulations. And so the notion of what is the right proxy for housing supply elasticity sort of shifts around the 1960s. And you could see this in a series by Ganong and Shog in which they tabulate the number of court cases that mention land use. And there's a trend break in the 1960s. And so pre-1960s, it's really driven by the availability of land or geographic topographical constraints. And then post-1960s, it's more of a legal constraint. Uh, in the modern era, you could create plots like this. So this is, if you rank all the different areas based on something like the Wharton Index, which captures political economy constraints to new constructions. This would be like voting procedures, number of steps in the approval process. You'll get this clear negative pattern between how stringent you are on that index and permits that have been issued per capita for single family homes. Okay, so I'm running low on time. Let me just show. So we do this exercise zooming in on the global financial crisis, and we rank the states based on, as of 2005, based on servicer data. Um, are they already like how subprime are the mortgages that have been originated during the 2000s boom? And it turns out that even after you strip out other sources of variation cross state, these states in red that rank really high in the subprime ranking are going to be the ones that have high beta predictability for stock return movements. So this is just to say that there seems to be some soft information, not about uh, the access to credit in the economy that building permits are capturing, but about the quality of credit. Okay, so it's not just about the buildup of leverage. Building permits are going to tell you something about, are these loans actually turning from good to bad um, on the eve of the crisis. You could also do a principal components version of this that I think lays out the story very nicely. So the first principal component here is the black line. And this also takes care of any sort of regional co-movement between different states to the extent you think Florida and Georgia are really highly correlated. So those signals are getting crossed. Um, we take this to be the first principal component basically follows the path of like a subprime leverage factor. So it spikes around the failure of Bear Stearns. It spikes when Lehman Brothers fails. And then this sort of aftershock in July 2010 is very interesting. That's when a lot of the homes that were foreclosed on during the financial crisis hit the auction market. Um, And then this is just a regression version of that. This is the from cross-section version. So let me just fast forward to where we are today, and then I'll conclude because I only have about a minute left. Um, so kind of zooming past COVID for a second, if you think about a lot of the housing price corrections that we're seeing in cities in the US right now, these are so-called work from home nomad cities. So what we do, and this is based off of a New York Times Upshot piece that came out about a year ago. Um, you can rank cities based on measures of inflows of people who, based on their industry that they were working in previously, whether they had the capacity to work from home prior to COVID. And so you can rank the cities based on their influx of work from home workers that decided to move in part because they can now be fully remote during COVID. Um, and so what you will see is that as the COVID recession starts to recede and people can move back to the office, um, you see that building permits crater on 6 months prior to a lot of these major house price corrections that we can see using Zillow or other house price index data. So, in other words, you could use building permits to predict which housing markets are going to become relatively more affordable in the future. Um, so we have this gross Stiglitz model. It will predict all the major empirical facts that I showed you today. The key one being, again, that there is this heterogeneity across geography in terms of how good you can predict stock return movements based on the housing supply elasticity, which is a key parameter. So let me just conclude. So hopefully I've convinced you that there is some truth to the idea that housing is the business cycle or the macro financial cycle. So we're really extending work by Lemur and a lot of other economic historians over a longer time period. And we're very open to ideas on how to use the data going forward, if not for this paper, then for future work in this area. And we hope to make it available soon in a way that's easy for people to download and use for their work. Thanks a lot, and looking forward to the questions from everyone.
Very good. Thank you for sticking to the limit. That's very good. There are some questions in the Q&A session. I'm not sure if you can see those questions, Cameron. So if you can, you might want to read them in case I don't read them as well as you do. So the first question here is about the firm level results with weights being time varying. And the question is whether that might be problematic and how about fixing weights over time. And then in this follow-up comment to that is, you might want to optimize location in response to crises. So any thoughts on that?
Yeah, so I went through this fairly quickly. We actually are using lagged population weights, or sorry, employment weights. So that would take care of some of this. Although I guess to the extent that firm movements or relocation decisions might be somewhat sticky, we could try fixing it, I guess, as of like, so most of that exercise we have from 1990s onwards. So the great financial crisis is going to dominate that. We have tried, I think, fixing those weights as of like 2000 so that we're not capturing, what the firms are doing potentially as they see, new goods orders going down in 2005, and those results look pretty similar. But point taken, the specification I showed you shows the weights that are lagged at least several months though. So we don't think that there's like reverse causality that's just coming from the weights. Um, yeah, and I can see the other questions as well.
Okay.
So I can. Um, so then there's a question here from Simon on focus on volatility of permanent value growth is interesting. Yeah. So. Again, this might be just because I went through it fairly quickly, but our main measure in all these tests is not going to be value growth, but actually quantities. So the valuation of these permits is tricky, in part because the value in the series over the full 100 years typically reflects the notion of quoted cost. It's like when you have a developer who's building a new home, and they file a permit, they typically have to write down what they think is going to be the cost to build. This is an ex ante measure, so it doesn't reflect the true construction cost, nor does it capitalize in the value of the land once the unit is actually completed on that plot. So it's a very amorphous thing to try and extract some information from the value itself. In fact, if you just use the value, so you deflate everything by the quantities, that construction cost doesn't really have any explanatory power. It's very noisy, and it tends to be somewhat correlated with this commodity futures index that I described, because you're basically just picking up like what lumber prices are doing. So that said, we mainly look at quantities. The second part to this question is interesting. So we focus on volatility because it maps nicely to this informational mechanism story that we're pushing. That said, we have some results that are return on return regressions. And so there's a question about like, is this more about upturns or downturns? Um, One thing that's interesting, so if you regress returns in the stock market on building permit growth in the last month or the last several months, you'll get a positive coefficient. However, if you kind of go a little bit further out. So you go beyond 1 quarter and you have 4 quarters of consistently high building permit activity. Um, that's going to be a negative predictor of returns at a longer horizon. So put another way, this is an overbuilding story, we think. So if you take building permit growth, you detrend it, and so you see building permits are really high relative to trend for like several quarters in a row, that's going to, by and large, lead to some sort of overbuilding. And so the firms that are implicitly exposed to this overbuilding are going to see new goods orders fall for them, and the returns are going to come down. So there is some asymmetry there that comes from this like overbuilding phenomenon. I think then, so Orkun has another question. Is there a way to control for the speculative housing demand intended for investment instead of these more? Yeah, so I guess one thing you could do is so we don't unfortunately know the identity of the people who are filing these permits. This is somewhat aggregated data. Um, but I guess you could think about like what are the ones that actually get exercised or not? Like some of the permits might be speculative in nature. I will tell you that like at least in the modern era where we have data on second homes purchases using something like CoreLogic microdata, the ones that turn out to be very subprime in terms of like the credit quality. So that exercise I showed you where you have like Indiana is like a super subprime market. That is not a state, for instance, where there's a lot of second home activity. So at least in the modern data where we can separate out these channels, there doesn't seem to be this doesn't seem to be driven by speculative home transactions per se, but we unfortunately can't fully rule that out over all the episodes in our sample because we don't have the permits, by the type of person who's issuing them. Simon has another question. So there's a large body of work spawned by authors at the BIS looking at financial cycles that characterize the cycles having 10 to 30-year durations and argues that it is driven by credit expansion. Yeah, okay. So to what extent are our findings for the US consistent with that body of research? So I guess there's two things. One is that seems to be a much more lower frequency exercise that I think, if I understand the papers that you're referring to, than what we're doing. You could think of what we're doing as sort of a nowcasting exercise, really trying to figure out what's going to happen in the next several months. Um, I think leverage is really important. So everything I was saying about these horse race regressions we run isn't to say that corporate or household leverage buildups aren't important. You could run versions of our regressions where you interact our new factor, so building permit growth with leverage, and that interaction is typically positive around these cycles where we know that there was a substantial buildup in housing market leverage, for instance. So that is to say, we think that leverage might be amplifying what we're finding. But even if you take leverage out, we're still getting this kind of informational content of the building sector. Um,
So can I
and
just
I'm happy to
interrupt
keep,
here?
yeah,
Can I just,
yeah.
there's an interesting question here from Patrick, which I think would be nice to answer. So you mentioned three missed stock market collapses. Were there any major building permit collapses that were not followed by a stock price collapse? So the
Any
opposite.
building. So false positives, basically.
Yeah.
Yeah, we don't have this result currently in the paper. We have found a few false positives. I guess like there are a couple around the 1970s, and we suspect that this might reflect again, like I don't think that building permits do well at predicting sort of geopolitical reasons for downturns. They're really more about like the fundamentals the domestic economy. So there's some episodes around like OPEC, for instance, the 1970s, where we get these false positives. But the false positive rate is going to be fairly low. I think it's, I mean, around 5 to 10% of all of the stock market crashes that we have in the sample are going to be false positives. I see Patrick has another question as well. If we could use building permits data to make a profit. Yeah, so actually we have another paper that's coming out very soon in which we do some cross-sectional asset pricing versions of this. So you could think of this as like you could build portfolios in which you basically during times where there's a big boom in the economy, they're more likely to be overbuilding that exposes some firms to declines in orders for their goods and services. And so during boom periods, you want to short portfolios of those firms and you want to go long those firms during recovery periods when there is the opposite of overbuilding. You're trying to recover. And so there isn't that much building permit volatility. So that's sort of the broad intuition of that paper. And I'm happy to chat more about that or send it to you when we have it, probably in the next couple of weeks, actually. Um, John, do you want me to keep going, or you have other ones that have come up
No,
before I
no,
finish
it
with my case?
just keep. I think you had finished talking, replying to Simon's question, and then so it's Francesco's question was the next one that was in order that you you might like to address.
Uh, okay, so yeah, so let me go back in the Q&A. So Francesco has a question about house prices are historically correlated with credit cycles. So it's like the Jordan, Schuler, and Taylor work, and housing-driven credit booms are especially dangerous, leading to financial crises. Can this pattern be related to your explanation of stock crashes for instance, by increasing the borrowing capacity of investors? Yeah, so I think this is kind of related to Simon's earlier question to some extent. Like, I would think of really the link between what we're doing and sort of the Jordan, Schuler, and Taylor leverage cycle paradigm is like leverage can amplify what's happening in the construction sector. Um, but it doesn't fully capture this informational effect that we're having. I mean, so certainly if you have a regression with our building permit growth factor and something like let's say corporate leverage ratios at the state level you can get from Compustat, or you could even look at for the modern era, you have things like debt service coverage ratios that the New York Fed produces. Um, you will still get that both of those contribute a pretty high incremental R squareds for stock return movements. Um, uh, but the betas and don't get killed off from R factor by including leverage. So I think it's really more of an amplification story that we're highlighting here. I guess one thing, if you were trying to back out some sort of like macroprudential policy rule, which is something that we've been sort of asked about in the past. Like, what would be, could we use building permits to go the other direction? So could we see something like if we see that like building permit volatility hits some threshold, for instance, does that tell us something about like the composition of the credit in the economy and how not just like are we going to be in a recession in the next few months, but is that recession going to be particularly deep and is it going to be indicative of a financial crisis? So that's something I think we'd have to think a little bit more carefully about. But I think it's interesting to think about like not just do we predict recessions, but do we predict the type of recessions? And I think the answer generally is that with building permits, we can predict both types of recessions. Um, but there might be some other ways to cleverly use the data to get at like how bad is the slump going to be, and is it mainly a financial versus non-financial crisis? Robert has a question so about intangible assets versus tangible assets since the 1960s. And right now we're mainly talking about, I guess, intangible assets in the current potential bubble with AI. And so this question about like whether housing permits are going to lead the next downturn. So I'll be fully transparent. I have been on the road for the past couple of months on a lot of seminars, so I haven't checked like what the building permit series look like most recently with respect to AI. I think if the last I checked around the end of 2024, going into the beginning of 2025, you were starting to see some dips in building permits. Um, kind of indicative potentially of overbuilding. Certainly that predicts these housing market corrections that we're seeing. Um, I think one thing that's maybe a little bit of a confounding factor is tariff policy here, which you could argue is domestic policy, but is a little bit dependent on the geopolitics because it's dependent on how other countries respond to that. But we did see some large drawdowns in building permit, even on a seasonally adjusted basis, at the end of 2024, that might have been indicative of a recession that didn't happen, perhaps around rhetoric with current tariff policy. So that is something I can say. But I think this tangibles and intangibles question is interesting. And one thing we could potentially do is, um, and we've disaggregated CRISP to some extent and looked at different Fama French industries and what are the industries that light up. We haven't tried to rank those industries based on their intangible asset share. I mean, measuring intangibles is difficult, but um, most of the NAICS codes are the Fama French fact industries that light up the most in terms of single family home permits predicting stock returns for that cluster of firms would be the finance and insurance sectors as well as manufacturing firms. So those tend to be the two sectors of the economy that consistently light up. So, but I think it's a good point. We can try and rank firms or create portfolios based on intangibility. I think, and I see one final question. How do we think about the secular decline in geographic mobility of the American workforce? And how does this change the stability of your results? Yeah, so I guess we're thinking here about like the extent to which, well, so I think you're talking about like like metro or cross state migration patterns. So actually, I think there's a debate about like cross-state migration in the CPS, and I think a lot of the government agencies that produce data for the U.S. that then gets used to produce migration rates were reformed at some point in the 2000s. So there's a question about like whether this is how much decline in geographic mobility there is. Um, but I guess like this could show up potentially in like the composition of single family versus multifamily homes. Um, and that's something that I'm not sure we can fully address with our data to the extent the multifamily series are much noisier. So I think ideally you would have like some sort of like share over time of all the units that are single versus multifamily, and then maybe a control for that composition effect across these different areas. If anyone has ideas on how we might do that to account for like not just mobility, but like how easy it is to commute into an area. That would be great. That would help us a lot. Just as an aside, I mentioned that single family home permits do a lot better than multifamily because of this, like, the probability that you complete a single family home permit is much greater. Um, with multifamily permits, the other issue is that you have these tax incentives that different localities will often throw around. And so even on a seasonally adjusted basis, you'll get weird things where like New York multifamily home permits spike in December 2008 because there's a tax credit that's expiring. And so you get these blips that are a lot of false positives because they're related to other types of local policy. So we need to strip those out. In a more systematic fashion, I think, to make use of the multifamily segment of the data. And I think I have a few more minutes. Like if people want to hang out until 11:15, is that right, John? Is there any other?
Yes, I
Uh,
think that's correct. I think right now we're at the 12 o'clock, well, actually 12 o'clock my time, 6 o'clock your time in Europe. But I do believe, is that correct? I think there's I'm not sure the mechanism. Do we stay here for t the next 20 minutes to talk, or do we go somewhere else?
No, we can stay here.
Okay, very good.
Fantastic.
Yeah,
yeah,
so like,
so I'm happy to chat for a few minutes if people
yeah,
have
so like,
additional questions.
I just want to say, like, it's very interesting. I think this is a fantastic sort of data set that could be very useful for lots of different projects. I sort of one last question. I'm sort of relates back to my work with Hugh Rockoff when we did sort of regional interest rates over the 20th century, right? And we saw much more integration in interest rates post 1935, right? Prior to 1935, it was sort of uh, a lot less integration in regional interest rates. Do you sort of see some similar in terms of the housing markets, in terms of sort of regional, much bigger regional differences early in this data set than say later? In terms of like
Yes,
the impact of monetary policy and credit policy and macro pru on the housing markets, right? If one to look at that, you know.
yes. So one thing that was a little surprising to us is we have this like um, so it's buried in like one of the theoretical appendices for the paper. Let me just kind of talk about what like the why this might be important theoretically, and then I'll address your question about like the regional co-integration. So like we have these building permits that we think are signals in relative to standard like information theory kind of framework. Like we have a signal that's being produced by all these different localities. Um, and so, baseline, you can get very nice formulas if you just assume that all these are all islands and that there's no regional co-movement in the housing market. Obviously, that's false. Um, so then we looked at like so we can derive very similar kind of testable implications if we allow for there to be some sort of like input-output matrix or co-movement between these different localities. Like potentially you have clusters like New England all co-moves and then Georgia and Florida. Some of that could be driven by interest rates and sort of like consolidation in the banking sector, as well as the role of the GSEs in coordinating pricing in the mortgage market. Um, that could definitely be the case. One thing that's interesting is if you look at just sort of the state by state pairwise correlations, they're never really that high month to month for building permits, even after you strip out the seasonality of the series. Um, However, for some states, they're consistently higher than others, and kind of going to the story that the states that are going to be have a high correlation overall with all the other states are going to be the ones that are really supply elastic. And so again, that's going to be a Florida or these areas where you have a lot of land that's developable and you don't have land use constraints. So we have that one of those heat maps of all the pairwise correlations in the paper. Um, at least for the post 1960s period. I don't know off the top of my head how it looks for pre 1960s, but it could be interesting to look decade by decade to get at your point, John. Like if you see that there's a shift in how that looks, depending on some sort of like co-integration of the mortgage market. But I was actually kind of surprised that there wasn't more regional co-movement of building permits.
Well, I think maybe this is the time we should formally or close the formal part and thank Cameron for a very interesting talk. We can do our virtual clap right now. And then I think, as Cameron said, Nathan has raised your hand.
Or you can close the seminar just this post closing.
Okay. Anyway, so and then now I think Cameron's willing to stay for another 15 to 20 minutes and answer sort of questions from people, right? Is that how it works, Nathan?
Yeah. So I can
Yeah.
I can kick off. I have a question. Thank you first of all, Cameron,
Yeah.
for
So thanks for having me.
and so thinking about these housing permits. So there's this, as you mentioned in the beginning, there's this treating them as an option value. So you're buying an option, basically a real option on the housing market. And so the value of these options, I guess, if you're following option theory, so increases with uncertainty and volatility. So so is there some underlying uncertainty that the increase in or the volatility in the permits is revealing? So in a sense that there's some underlying uncertainty that makes these things valuable, and people are competing, they're raising the prices, and so I was just trying to see whether it's kind of a follow up on this option theory story, or is it more of a real investment Tobin's Q type of thing, where sort of you have these house prices going up, and then beyond the existing home prices go up versus the new house prices, and then somebody, so how do you fall on this, and how do you interpret the signal based on that? Yeah.
Yeah, so okay, I think so one thing is that we don't really have a way to get at like what is the value of the permit, like the option value of the permit itself. I think that's a really tricky object to get at. What we have essentially is like the cost of construction if you were to follow through on the permit, um, which is not really a good proxy for the reasons I've discussed. I think of this basically as well, okay, let me say. So there are other things that you could think about, like even though we can't observe like the price of the option. So one thing I will say is that people will not indiscriminately file permits because the permits have fees associated with them. So that's important, and those fees are not going to be moving at very high frequency. They're basically going to be set at maximum on an annual basis by whatever the town planning council is that is setting these building codes, right? So that's essentially the supply curve for these permits is not moving very much over time. But the fact that there is a fee structure suggests that people would not just strategically permit, even if they have no intention really of building. And that's why I think that there is actually, otherwise it would just be noise. So I think that's something that's important to realize. Another kind of theory, if you think about like textbook like real estate development theory with these permits, is that people often talk about the value of waiting problem. So like if it could just be that like people permit and then they sit on the permit and they don't actually build. They hold it basically until it expires and they try to renew it. Um, in part because they want to see how the economy shakes out. So that I think would be like, the permit is gonna kind of consistent with that story. Like as volatility goes up, the value of the permit is gonna go up, right? Um, at the same time, what that theory will predict is kind of at odds with the modern data in the sense that a prediction of that theory is that as volatility keeps going up and up, yes, the value of the option value of the permit goes up, right? But then you should actually see that people permit less as volatility kind of goes up and up on the eve of these crisis episodes. What you see in the single family home market is not that. You see if anything, permits are flat and they slightly increase, at least around the 1990 to modern era or current era where we have a data where we can actually track individual permits. So I think that theory faces a little bit of a problem when you take to the modern data. It could be that if you extend this out further, and if you do it certainly for multifamily homes, I think it would have some truth to it. But I think that like doing this with single family homes kind of indicates that it's an informational story. Sort of a long answer to your question, but like that's how I think about mapping it to like the textbook like option theory version of real estate development.
Thanks.
So just a follow-up comment or question. Do you have data on housing starts? Can you like, because I mean, if you start seeing some quite sort of differences and changes in that the difference between the permit and the housing starts, right? That would be a way of measuring some sort of you know uh, uh, I don't know.
Like, yeah, like basically, is there informational content in like the number of permits that actually complete?
Well, not it doesn't have to complete, right? It's just like at the time, it's the start, whether it turns into an actual housing start, right? In terms of like the speculation, right? Whether because I don't know what the fee structure is, but I can't imagine it, it's that high that it would stop somebody if they were really speculating. And it just might be a way of measuring sort of the amount, the speculation that's going on, right? When you say single family housing, do you mean you're not including things like apartment complexes, townhomes? Those are not considered
That's
single family.
that's
Because
right.
I'd imagine in Florida, right, that's a large chunk of the modern housing infrastructure, right? So you're completely losing all that,
That's right. So it's just single family homes.
right?
Um,
Is
so,
that
so
just data availability, or is that because that's what you
I,
chose,
we have multifamily homes in there.
right?
We have separate buckets for so 2 to 4 units would be like, multifamily, but these could just be townhomes, right? And then you have a separate series for 5+ unit multifamily. Those are available from 1960s onwards, so we can't span the full 100 years doing that. So that's
Right,
one reason. But the main issue is just that multifamily housing, the permit series are much more reactive to local policies that are aimed at developers. So, for instance, like low-income housing tax credits, sort of property tax abatements that are given. And so I think to really use those series, we would have to collect like a separate database of like here are all the different like credits that develop because these are usually not extended to single family homes. Um, and so we're kind of by looking at single family homes, it helps us strip out some of this policy variation, which is largely going to be orthogonal um, to the real. I mean, to be clear, it's policy variation, but it's like it's really policy uncertainty about whether the credits and abatements are going to be renewed. And that creates this kind of month-to-month variation that is unrelated to the business cycle. That's what we're concerned about with multifamily permits.
right. Okay,
But yeah, we do have building starts. We don't have it geographically disaggregated. So the census has been producing a building starts series um, since the 1960s. I think there have been some efforts. I think Lemur actually has in one of his papers, he's tried to splice this together with some older series. Um, but I haven't seen anything that's like as geographically disaggregated as the permits are. So we wouldn't be able to do something like the wedge between permits and starts over like geography by geography over long time periods. But we have done like sort of as a just a test like what is the pass through of permits to single family permits to building starts. Um, I guess for that exercise, like building starts is typically single family plus multifamily. So we've added up single family and multifamily and then regressed one on the other to try and get a sense of like how many complete on average. Because multifamily is in there, it'll be around like 60 to 70%. If I recall, it doesn't actually move that much with the cycle. So it's kind of interesting that and I think it's because most of the building is happening on the single family side, and actually the completion rates are not that cyclical. Um, but I think one thing that would get at potentially speculative activity is to look at the difference between permits and completed units, and that I think we could do more on because we have a survey of construction and that goes back fairly far, um, where we could do something like this. Yes, again, I don't think we're going to be able to do any of those exercises over the 100-year period.
right. So how does it work for the people in um, the attendees? Can they maybe raise their hands if they have any questions to ask? Is
Yeah,
that how it works? Yeah.
yeah, yeah.
Okay.
That's it. So it's more informal, right?
Okay. Yeah. Exactly.
But we're really coming to the end. I just want to piggyback on both of Nathan and John's earlier points, right? So I understand that you don't want to get into another complicated data collection, for all the state and municipal level variations in regulation, taxation, and so on. But can you, just out of curiosity, so these real options, as Nathan defined them, so they have I imagine a strike price, right? Which you guys are indirectly trying to estimate. But there's also the question of the fees, right? So you said that people were not, just strategically filing these permits, even if they even hadn't raised the financing just for the value of it. But how big were these fees, and do you know whether they varied across space and time.
Yeah, so that's a great question. So, and I think that more work needs to be done in historical housing on this point. I have a separate paper that's a descriptive paper about property taxes that speaks to this question for the modern era. So in the modern era, you have some states that use permitting fees as actually an alternative form of property taxation. So, for California is very famous for this in the US. So some counties in California set the cost of a permit for a new single family home in excess of 10% of that quoted construction cost. However, if you take out a couple of outlier states, so California being the big one, Florida has actually fairly high permitting fees, but closer to 1 to 2% of the quoted construction cost. They're around 1% for the median county.
Right, but those are one-time fees, right? It's not like every year you sit on the permit, you have to pay an extra 1% or something.
That's right. It's a one-time fixed cost. Of course, if you renew or you get another permit. I mean, you could also, we don't observe the fees for, all right, well, so we could do this in the modern era. Like, so you could say, okay, well, that's the fee for just getting the structure built. Obviously, there's a lot of other things you need to do to get the house move-in ready. So like there's a question then of like what are all of the permit fees added together? That I'd have to tabulate for the modern era. I don't know how you would. I haven't seen any renovation permit series going back further. So, but I think in theory, just to be clear, like we use new building permits because it's available over the long time period, and a lot of countries have been collecting that. But I think that the intuition that we're raising in this paper would extend to renovation permits as well, if you could do this. And there has been some interesting work using renovations from like listed housing, like sort of realtors listing of houses for sale that has tried to extract the renovations from the text and show that you can predict the cyclicality of individual housing markets using just the renovations. So I think that the intuition would translate if we had the data. Yeah.
Fantastic. All right. I think we should put a stop. John.
Yes, very good. Thank you, Cameron. And I look forward to seeing further versions of this paper and maybe all your other papers too. That's very exciting.
We have another one. We have another one on housing supply elasticities over the long run. So that's the next use of the data. So I hope to be in touch with some of you soon on that one. But thanks a lot for the comments. Thanks for the opportunity to chat and good feedback.
Yeah, come back again.
Thank you.
Thank you.
And thanks to everybody else.
Thanks, John.